Hi and hello, we are from Group 6. We are presenting on the company we choose, which is Malaysian Airline Berhad. In this slide, you can see the name of our team members. I'm myself, Tanusha. Without further ado, I briefly cover the background of Malaysia Airline Berhad, or MAB, and the key timeline that shaped its current reporting and governance environment. MAB is Malaysian national full-service airline providing both domestic and international passenger and cargo services. However, the company has faced long-term structural pressures, including high operating costs, intense competition from low-cost carriers, and recurring profitability challenges. Okay, the timeline begins from 2014 as the issue becomes significantly worse. Following the MH370 and MH117 tragedies beyond the human impact, these events created a major reputational and operational shock, which weakened the consumer confidence, reduced demand, and increased financial stress. In response, Khazanah Nasional led a major recovery effort. Moving into 2015, the airline went through privatization and initial restructuring program. This included cost rationalization, workforce reduction, route rationalization, and tighter capacity management. While these actions improved efficiency in certain areas, they also introduced major reporting considerations such as how to account for restructuring costs, employee-related obligation, and management forward-looking assumption about recovery. From 2016 to 2019, MAB experienced ongoing losses, and only a fragile recovery improvement were often gradual and not strong enough to build a stable financial buffer. This meant the company's financial position became increasingly dependent on forecasts and assumption about demand and long-term sustainability. Then in 2020, COVID-19 triggered a severe collapse in air travel, intensifying liquidity pressure and increasing reliance on financing and state-linked support. This environment increased sensitivity in financial reporting, particularly around cash flow projections, asset values, and going concern assessment. From 2021 onward, as a travel reopened, MAB forced on recovery planning, but continued to face balance sheet pressures from long-term commitments like fleet and lease obligation. Finally, in the recent periods, stakeholder expectations have shifted towards stronger transparency and governance, increasing scrutiny over disclosure, decision justification, and oversight. That said, the context for why financial reporting judgment, governance, and audit focus areas become especially critical for MAB. Thank you.
Good day to Doctor. My name is Lim Zan Wei, and today I'll be presenting Issue 1 which related to impairment of assets under MFRS 136. These standards ensures that assets values are not carried above their recoverable amount, which is particularly important in the airline industry where airline invests heavily in long-life assets such as aircraft, engines, and maintenance facilities. For Malaysia Airlines Berhad, this became more critical due to persistent operating losses, restructuring efforts, and volatile passenger demand following the COVID-19 pandemic. Next, how does this impairment issue arises? The impairment issue arises because Malaysia Airlines Berhad is facing persistent losses, route suspensions, and demand fluctuations from time to time, and the impairment testings depends heavily on management forecasts. During the restructuring phases, management may adopt optimistic assumptions about future passengers volumes, fuel costs, or pricing. While these assumptions may support turnaround narrative, they can delay or understate the impairment losses, contrary to the intent of MFRS 136. Furthermore, operationally, overstated assets values can mask inefficiencies in loss-making roads or high-maintenance fleets. This weakens the management ability to make timely decisions on fleet rationalization, road restructuring, or asset disposal, which prolongs the financial strain on the airline. Last but not least, from a financial reporting and governance perspective, delayed impairment recognition can overstate assets and equity, which will create a misleading impression on financial strain. When impairments are eventually recognized, they often appear as one large losses and sharp declines in profitability. This will eventually raise audit risks and can reduce confidence in previous financial reporting. In short, ensuring compliance with MFRS 136 is not only about technical accounting treatment, but also about providing a more faithful representation of Malaysia Airlines Berhad's financial positions in a highly challenging operating environment. That is all from me for this part. I will pass the slide to the next presenter. Thank you.
Greetings, Doctor. My name is Alina Bila. Under MFRS 136, Malaysia Airline Berhad has implemented improvements in its impairment assessment process. The airline enhanced the identification of cash-generating units by grouping aircraft based on flat type and operation segments rather than assessing assets individually. This ensures impairment testing reflect how assets actually generate cash flow. In addition, management adopted more conservative assumptions in value-in-use calculation, particularly for passenger demand, fuel costs, and load factors. This reduced the risk of overly optimized projection actions, delaying impairment recognition. Operationally, Malaysia Airlines Berhad also carried out fleet rationalization by pressing out older and less fuel-efficient aircraft and restructuring loss-making routes. Overall, these measures improve compliance with IFRS 136, reduce the risk of assets overstatement, and support better management decision-making. Although impairment testing still involves judgment, the solution enhances transparency, reduce audit risk, and provide a more faithful representation of the airline's financial position.
Hello, my name is Lala Maisara and I'll continue for the Issue 1 Impairment of Assets Recommended Solutions. So for Issue 1, these solutions focus on making impairment testing more reliable and transparent. In the short term, MAB should engage independent valuation experts to assess the fair value of aircraft assets. So this provides an unbiased second opinion, reduces management bias, and also strengthens the audit confidence. Another short-term improvement is reverse stress testing disclosure. Instead of vague sensitivity ranges, MAB would disclose clear tipping points. For example, exactly how much fuel prices would need to increase before impairment occurs. This gives stakeholders a clearer understanding of risk. So in the long term, MAB can adopt Monte Carlo modeling for impairment testing. Rather than relying on a single forecast, this approach runs many scenarios to show the probability of different outcomes, helping management make better risk-based decisions. And finally, by integrating impairment monitoring into the ERP system, MAB can track early warning signs like rising maintenance costs in real time. This allows issues to be addressed earlier instead of facing large and sudden write-down.
Next, I'll be presenting Issue 2, which is the Revenue Recognition Challenge under MFRS 15. This is because the airline receives substantial cash in advance from ticket sales and cargo services. However, under MFRS 15, revenue cannot be recognized immediately. Instead, it is only recognized when the airline fulfills its performance obligations, which means when the flight actually takes place. Before that, all advance receipts from customers must be recorded as liabilities. The issue becomes complex because airline revenue involves estimating cancellations, refunds, rebooking, and unused tickets. During operational disruptions such as route rationalization or sudden changes in travel demand, Malaysia Airlines Berhad must determine whether the performance obligation will still be met or whether the refunds are expected. If the management adopts optimistic assumptions, this may lead to premature or excessive revenue recognition, which is contrary to MFRS 15. Furthermore, operationally, overstated revenue misrepresents actual business performance and can impair the management decision-making. From a governance perspective, revenue recognition becomes highly judgmental, which will increase the audit and compliance risk, as auditor will challenge the assumptions relating to refund rates, customer behavior, and contract modifications. These issues can ultimately affect the management credibility and stakeholder confidence. Last but not least, financially, the risk is that revenue and profit may be overstated, while liabilities and equity may be understated. If cancellations and refunds materialize later, the airline may face significant revenue reversals and refund-related cash outflows. This not only distort the profit trends, but also create liquidity trend, which can translate into long-term business continuity risk. In short, the revenue recognition issue highlights how MFRS 15 requires discipline and strong internal control in order to faithfully reflect the performance in an industry that is highly uncertain and operationally volatile. That is all from me for this part. I will pass the slide to the next presenter. Thank you.
For revenue recognition under MFRS 15, Malaysia Airlines Berhad strengthened its revenue recognition framework to ensure revenue is recognized only when performance obligations are satisfied. Advanced ticket sales are consistently recorded as contract liabilities under flight are complete in line with MFRS 15 requirements. The airline also refined its estimation of cancellations, refunds, and unused tickets by using historical data and current booking trends, especially during periods of operational disruption. In addition, improvements in ticket and revenue management system allow better tracking of flight completion and customer behavior. Government was further strengthened through enhanced audit oversight and clearer disclosures in the financial statement. Overall, this solution reduces the risk of premature revenue recognition, improve financial transparency, and enhance stakeholder confidence. While revenue recognition in the airline industry remains complex, Malaysia Airlines Berhad's approach supports more reliable financial reporting in a violent operating environment. That's all from me. Thank you.
For issue 2, the revenue recognition, the aim is to improve revenue recognition accuracy and reduce breakage estimation risk. In the short term, AI-powered anomaly detection can monitor ticket sales and contract liabilities in real time. This ensures revenue is only recognized when flights are actually completed and flags any inconsistencies early. MAB can also use actuarial methods to estimate ticket breakage more accurately. By analyzing historical redemption patterns across different customer groups, breakage revenue is recognized more conservatively and realistically. And looking ahead, blockchain-enabled smart contracts can automate interline settlements. Once a flight is completed, revenue and payments are recorded automatically, reducing manual errors and disputes. And lastly, machine learning models can predict passenger no-show and breakage rates using multiple factors like demand, patterns, and weather. Over time, this leads to more accurate and timely revenue recognition.
Good day to Doctor. I answer. For issue 3, Malaysia Airlines Berhad faces a major accounting challenge under MFRS 16, which replaced MFRS 117. Under MFRS 16, most leases must now be brought onto the balance sheet. This means MAB has to recognize a right-of-use asset and a lease liability measures as the present value of future lease payments. Compared to the old approach where operating leases could stay off balance sheets, this improves transparency, but it also makes measurement and disclosure much more complex. This issue happens because MAB relies heavily on leasing aircraft, engines, and related equipment to run daily operations. Airline leases are really simple. They often include extension options, variable payments linked to usage, and maintenance-related obligations. Under MFRS 16, management must decide whether extension options are reasonably certain to be exercised, estimate the lease term, choose an appropriate incremental borrowing rate when the implicit rate is not available, and separate or assess optional and non-lease components. These areas involve a lot of judgment. The financial impact is significant. Once leases are recognized, reported assets and liabilities increase, which affects leverage and gearing ratios. The expense pattern also changes because operating lease expense is replaced by depreciation and finance costs, which can reduce short-term operating profit. If judgment like the borrowing rates or lease term are misestimated, it can lead to material misstatements and weaken stakeholders' confidence. That is why strong internal controls and clear, detailed disclosures are essential.
Good day to Doctor. My name is Ahmad Akasha. I will present the solution executed and the evaluation on issue 3. To understand Malaysia Airlines turnarounds, we must first look at how they tackle a massive solvency crisis triggered by the pandemic and the legal requirement of MFRS 16 leases. So MIB didn't just negotiate, they innovated. They utilized a UK scheme of engagement to legally reset their legal obligation under English law, settling over 15 billion in debt. Simultaneously, they moved from fixed rental to a power by the Howard PBH model. So this was a masterstroke in accounting. Under MFRS 16, variable payment are recorded as lease liability. By doing this, MAB successfully they recognized massive debt from their balance sheet to manage their data-heavy transition. They migrated to SAP S/4HANA, automated the complex recalculation required by the standard. The evolution is clear, it's work. This strategy provides the breathing room needed to survive. By 2023, MAB reported its first ever net income after tax of 766 million and a cash reserve of 4.3 billion. They ever reversed 426 million in asset impairment, proving that their fleet had transitioned from a crippling liability back into a valuable asset.
Moving on to the third issue, it explains how Malaysia Airlines Berhad can strengthen its response to MFRS 16 through both short-term control improvement and long-term strategic alignment. So in the short-term perspective, a key challenge is determining an accurate incremental borrowing rate, or we call it as IBR in short, particularly in the aviation industry where lease structure are complex and market conditions are volatile. So while SAP S/4HANA improved data processing, IBR remain a high judgment and high risk area. So establish a formal IBR governance framework, anchor and observable market data such as credit spread and lease tenure, improve consistency, reduce management bias, and enhance the reliability of the reported lease liabilities. So in addition, enhance lease sensitivity disclosure helps stakeholder better understanding the financial impact of MRI 16, especially as MAB transactions from pay by the hour arrangement back to the fixed lease payment. So this disclosure clarify how changes in assumptions affect the lease liability, EBITDA, and gearing. However, for a long-term perspective, MAB should embed MFRS 16 consideration into fleet planning and acquisition decisions. So research shows that when accounting and operations are misaligned, it can lead into unexpected financial volatilities. So integrating lease accounting impact into lease versus buy decisions ensure the fleet growth support both operational efficiencies and financial stabilities. So finally, treating lease accounting as a continuous process with senior management and audit committee oversight ensure assumptions remain aligned with the economic reality over time. Overall, this approach enables MAB to move beyond compliance toward a stronger governance and strategic financial resilience under MFRS 16.
For issue 4, Malaysia Airlines Berhad faces a key accounting and governance issue involving related party transactions or RPTs. These are transactions between MAB and connected parties such as subsidiaries and associates, key management personnel, major shareholders or entities under common control. Because RPTs can affect fairness and transparency, they must comply with MFRS 124 and Bursa Malaysia's main market listing requirements also require proper disclosure and approval procedures. This issue is common for MAB because it operates within a wider group ecosystem, so intercompany services and business arrangements happen regularly, including dealing within the Malaysia Aviation Group such as Firefly and Mars Cargo, and also party linked to director or major shareholders. The main risk is that these transactions may not be at arm's length, so pricing and terms could be non-market or preferential, which can distort reported performance. That is why transparency and oversight are critical. MAB must clearly disclose the relationship, transaction types, and also the amounts, and ensure strong controls such as documentation or the committee review, board approval, and when material, shareholder approval or mandate for recurrent transactions. Weak disclosure or governance can trigger regulatory issues and reduce investor confidence.
While the first part was about the balance sheet and the second was about integrity and efficiency, and maybe took a hard stance on commercial decoupling to fix legacy inefficiencies. The solution executed that the landmark move was ending a 26 years monopoly with Brahim Food Service. This was a classic related party transaction that no longer served the airline interest. MME demand arm length term and when met their resistance, executed a hard exit. They diversified their supply chain with a partner like Post Aviation and launched their own unit, MAG Catering MCAT. Furthermore, they fortified their governance by becoming the first Malaysia airline to achieve ISO 37001 anti-bribery certification, ensuring that merit basis of procurement. The evolution here show a pain for gain trade-off. In the short term, this caused the infamous catering mess, leading to a public criticism and service dips. This highlighted the risk of unwinding a deeply integrated vendor too quickly. However, in the long term, the decoupling stopped value leakage to trouble parties and allow a full cost reset. By late 2023, service was fully restored under a more resilient multi-vendor model. Ultimately, this proved that MAB commitment to institutional good governance, prioritizing a business viability over their legacy relationship. And that's it for me. I'll pass to the next presenter.
Looking to the last issues of this case study, which focuses on how Malaysia Airlines Berhad can strengthen governance over related party transactions in both short and long term. So in a short-term perspective, the key risk with related party transactions is not deliberate misconduct, but fragmented reporting across a complex group structures. So different subsidiaries may enter into transaction without a full group-wide view, increasing the risk of omissions or late misdisclosure. To address this issue, MAB can centralize RPT monitoring under group finance and governance with direct report to the audit committee. So require RPT to be disclosed at contract initiations rather than the quarter end. It creates a single source of truth and significantly improves transparency and timeliness. Another short-term priority is ensuring the transactions are generally conducted at arm's length. While policy already exists, stronger audit committee challenge can be introduced by requiring independent pricing benchmark or external quotations for material RPT. Where necessary, independent valuers or tax advisor can provide assurance, reinforce credibility, and investor confidence. From a long-term perspective, RPT risk should be embedded into MAB enterprise risk management framework rather than treated as a standalone compliance issues. OECD research shows that recurring RPT issues often stem from weak integrations of conflict of interest risk into enterprise-wide governance. So this approach shifts MAB from reactive detections to proactive prevention. Finally, governance must be supported by ethical culture and capability building. Scenario-based training and linking disclosure quality to performance evaluation help to ensure RPT transparencies become a leadership responsibility, not just a box-ticking exercise. Overall, this measure moves MAB beyond technical compliance toward a transparent, proactive, and trusted RPT governance framework.